cover up the entire lesson today. Okay, so I have shared something sort of like a workbook with you guys. I hope you all have received it by now. Okay, so now I think most of you know that cost volume profit analysis or CVP analysis, it's actually in your grade 13 syllabus. It's a lesson from your grade 13 syllabus, right? It's the one before last. So this unit, unit number 15, we actually call it the marginal costing unit. It's the lesson regarding marginal costing. Okay, so CVP analysis is actually not from the beginning of that lesson. So, but the beginning is the introduction part, which I'll explain it to you guys first before I go into CVP analysis. Okay, so if you feel like there is something that you don't know by now, if you feel like there's something that is important for you, feel free to take down any notes other than the ones that are questioned here. Okay, so all right. So just to start off, now let's start with marginal costing. What is marginal costing? All right, so marginal costing is basically the additional variable cost of producing one more extra unit. Now let's say, in order to produce 100 units, our cost is 100,000 rupees. All right, in order to produce 100 units, our cost is 100,000 units, 100,000 rupees. So in order to produce one more unit, if you are producing 101 units, okay, not 100, now you're producing one more additional unit, 101 units. Then by which amount would your cost change? Now, initially your cost was 100,000 when you were producing 100 units. And if you're producing one more extra unit, by how much would your cost increase? So that amount is what we call marginal costing. Simply put, marginal costing is a variable cost of producing one more additional unit. Okay, so I hope what marginal costing is clear to all of you. And then, so under marginal costing, we will be talking about different types of costs. Okay, so I'm just telling you this, guys, because it's important for you to have this understanding before we go into the CVP analysis, which is the important part of the lesson. Okay, so now different types of costs. I'm sure that you all are familiar with these costs. So we have fixed cost, we have variable cost, and those are the main two that we are going to talk about. So fixed cost, so fixed cost is basically the cost which varies, which does not vary actually, which does not vary with the activity level. Now, if you take, for example, let's take rent of a building. All right, so let's say the rent is, okay, let me share the screen. Okay, so let's say the rent of a building, let's take the rent as your fixed cost. Rent is 100,000. So if you're, and then let's take the quantity along with this, the units. So if you're producing 0 units, still you have to pay the rent of 100,000, right? Even if you're producing 0 units, you still have to pay your fixed cost, which is your rent. Let's say you're producing 10,000 units. Still your rent will be at how much? At 100,000, right? So fixed cost is the type of cost which does not vary with the activity level. Even if you don't produce, or if you produce 1 unit, 2 unit, 1,000 unit, 10,000 or even more, fixed cost will remain constant. Okay, that's the assumption that we make about fixed cost. And also something additional, so this might be important when it comes to the first paper. Sometimes this is questioned. Now, if you draw the graph for fixed cost, so total fixed cost, now taking this side as your cost side, like the rupee side, and this side as your quantity, okay, the units. The total fixed cost, now listen carefully, this is total fixed cost. Total fixed cost will be a straight horizontal line parallel to the horizontal axis that you have. Okay, so this is your total fixed cost line. It's very important to remember that this is your total fixed cost line. But if we draw a separate graph to show the unit fixed cost, okay, same axis, to show the unit fixed cost, that graph will be something like this. All right, so unit fixed cost is something which keeps going down. Now at this level, let's say when you're producing, when you're operating at this level of quantity, let's say this is 1,000 level. So 1,000 level of, let's just for the convenience, let's say 1. If the level is 1, your unit fixed cost, let's say it's 100. And if your level goes down to 2 now, if your level goes down to 2, now your unit fixed cost is a little bit lower. So how do you get the unit fixed cost? That's total fixed cost divided by the number of units. So unit fixed cost is something that keeps on declining. All right, so it's important to remember these two graphs. Total fixed cost is it's a fixed line, parallel line. Unit fixed cost is something that keeps on declining. So that's about fixed cost. All right, now moving on to variable cost. So I'm sure that you guys know, I'm just trying to refresh your memory on the main two types of costs that we have. So variable cost is the type of cost which varies with the activity level. Okay, for example, if you produce 0 units, your variable cost is 0. If you produce 1 unit, your variable cost goes up, let's say 100 rupees. If you produce 2 units, 200. It changes proportionately. If you produce no units, your variable cost is going to be 0. That's the main difference between fixed cost and variable cost. So variable cost, it varies with the activity level. Okay, so if I show you the total variable cost, it's something that goes like this, total variable cost. That means if you are producing, let's say if you are producing 100 units, your variable cost would be, your variable cost would be, let's say 100,000. If you are producing 200 units, your variable cost would be maybe 200,000. So proportionately, it keeps going up. So this is the total variable cost graph. The first one is the total variable cost graph. Okay, so talking about the unit variable cost graph, it's going to be something that stays constant. Your unit variable cost graph is going to be a straight line like this. The reason is, now let's take this scenario. Now first variable cost per unit is, let's say 100 rupees. Okay, variable cost per unit is 100 rupees. Now this second graph is the unit variable cost graph per unit. So if you produce 100 units or 200 units or 300 units, still the per unit variable cost remains at 100 rupees. Okay, so unit variable cost graphs move like this. So I hope that part is clear. How fixed cost graphs move and how variable cost graphs move. Okay, so with that understanding, we're going to the CVP analysis part of the lesson. Okay. Now in CVP analysis, so CVP analysis, it basically talks about cost. CVP refers to cost, volume, and profit. Okay, so this shows the relationship among cost, volume, and profit at different activity levels. That is what we call CVP analysis. This is what we are analyzing in this lesson. The relationship among the cost, volume, and profit at different activity levels. Okay, so I want you guys to take down on your tute what CVP analysis refers to. So this is a method of studying. This is a method of studying, so you can take it down here. The relationship among, this is a method of studying the relationship among cost, volume, and profit. Cost, volume, and profit level under each activity level. Okay, so that is what CVP analysis is. That is what we will be doing throughout this lesson. Now keep in mind, when you carry out this CVP analysis, we set a set of assumptions, right? We set a set of assumptions, and these assumptions might be practical in certain scenarios, might not be practical. Okay, so based on that, you can decide whether CVP analysis is a good technique for your company or whether it's not a good technique for your company. Okay, so next part, it's about the situations where we use this CVP analysis. Okay, so we use CVP analysis. Now this is for, we are talking about, something I forgot to mention is that now we are talking about management decisions. We are not talking about financial accounting. We are talking about management accounting now. Okay, so here decisions are of two types, short-term decisions and long-term decisions. Management is required to take short-term decisions as well as long-term decisions. Now CVP analysis and marginal costing, it comes under short-term decisions. Okay, it comes under short-term decisions. And then under long-term decisions, we have net present value calculations. So I think you all are familiar with NPV by now. So net present value calculation, it's about the investment decisions. So it's important to know that this lesson is about short-term management decisions. It's about short-term management decisions. Okay, so then what are the instances we use this CVP analysis? We use CVP analysis in various instances, like to calculate the product mix, if we are preparing budgets. Okay, so for things like that, for short-term decisions like that, we use our CVP analysis, cost volume profit analysis. All right, so just take it down. Used in following situations. So CVP analysis is used in these situations. So first one is preparing budgets. Okay, preparing budgets. Next one, when deciding sales quantity and prices. Deciding sales quantity and prices. Next one, deciding sales mix. Last one, analyzing production capacity and cost structure. Cost structure. Okay, so I'll give you guys a few seconds to take this down. Okay, so now these situations, if you read these situations, you'll understand that these are actually short-term situations. So that's why we say that CVP analysis, we use it for short-term decision making. Marginal costing is only suitable for short-term decision making, not long-term. It's very important to remember that. Okay. PDF, isn't it shared with you guys? Didn't you guys get the PDF? No, okay. Can we get it shared on the group? Is there a way to get it shared on the group? Okay, just give me 1 second, I'll look at it, right? All right. Okay, I'll look into it. Okay, I'll look into it and I'll. Okay, great. It will be shared on your seminar group. So just for the time being, take these things down on a notebook or something. You guys will get the PDF soon. Okay, somebody wanted the definition of CVP analysis, so I'll read it out. Quickly take it down. We already covered that part. So the definition of CVP analysis is, it's a method of studying. It's a method of studying the relationship among cost, volume, and profit under each activity level. Cost, volume, and profit under each activity level. Okay, under each activity level. You guys also can take down that this is suitable for short-term decision making. Okay, for short-term decision making. Everybody has taken down up to this level. Okay, on your notebook or on a paper. Okay, so these are the situations where we use CVP analysis. Now moving into important areas. Now next we'll see, okay, I'm gonna erase this, these points. Okay, so next we'll see what are the So next we'll see what are the assumptions that we use when we use this CVP analysis. What are the assumptions? Okay, so first assumption is we classify the total cost as fixed cost and variable cost. Okay, we just say that we don't have anything else. We only have either fixed cost or variable cost. So write down the first assumption and then I'll explain why it's a practical assumption, or whether it's a practical assumption or whether it's not. Okay, so first take it down. Total cost can be classified. Total cost can be classified as fixed and variable. As fixed and variable. Okay, total cost can be classified as fixed and variable. Okay, so that's what CVP analysis says, that we can classify total cost as fixed and variable. But in reality, this is not a very practical situation. Okay, so why is it not a practical situation? Why can't we classify cost only as fixed and variable? Does anyone have any answers for that? If you guys know the reason, drop it in the chat box. If not, listen how you can calculate, how you can classify total cost other than as fixed and variable. Exactly, good. Okay, so I'm getting few answers. Yes, because some costs are either semi-fixed or semi-variable cost. That's a very good answer. Okay, so we have costs like semi-fixed and semi-variable cost as well. Now, for example, semi-fixed, another name for that is actually stepped costs. Okay, we also call it. Now, let's say the rent of a building. Okay, the rent of a building. Now, let's say this building has a cap. Okay, let's take a warehouse, rent that you pay for the warehouse, the storage space. So let's say the rent that you have to pay for the warehouse is 100,000 rupees. Okay, 100,000 rupees. And the capacity of the warehouse, let's say it's only 10,000 units. There's a capacity, right? There's a maximum capacity. We cannot exceed that. So the maximum capacity is only 10,000 units. So your fixed cost will be constant, will be 100,000 up until you produce this maximum capacity of 10,000 units. Up until 10,000, now units are shown here in this side. Up until 10,000, your fixed cost will be 100,000. The moment you exceed the 10,000, if you go and produce, if you go and store 10,000, 100, 10,000, 200, or 12,000, 11,000, anything more than 10,000, you will have to rent out another storage space. So your fixed cost will now increase. Let's say for that also the rent is 100,000. Now your fixed cost is going to be 200,000. There also you can store only another 10,000 units. So up to 20,000 now your spaces. And the moment you exceed the 20,000 limit, again you have to rent out another storage space. So it will be the same cost for another 10,000 units. Right? Likewise, it will go on it will keep on going up in the form of steps. So this is what we call semi-fixed or step cost. So this is a possible cost that can take place in a business organization. Okay, so this is one other type of cost other than the fixed and variable. And in addition to this, we also have something called a semi-variable cost, or else we can call it a mixed cost, semi-variable or mixed cost. Okay, so that is of two types. One can go like this. Okay, it starts at a fixed point. It starts at a fixed point, and for every variable unit that you produce, they charge a variable cost. If it's increasing according to the number of units, then can't it be variable? Yeah, it can be variable. So the semi-variable, I'm hoping that you're asking about semi-variable. Semi-variable is initially there's a fixed cost, and then after you pay the fixed cost only, it keeps on increasing per unit. Okay. Other name for semi-fixed is stepped cost. I'll write it down here. Stepped cost. Other name for semi-fixed. Okay. So now in here, now what I'm talking about is semi-variable cost. So semi-variable cost, it actually starts at a fixed level. You have to pay a fixed level, and for every unit that you have to pay a fixed fee, and for every unit that you consume, you have to keep on paying a variable amount. An example for this would be the telephone connection that you have. I'm talking about the landline telephone connection that you have. So let's assume just to get the connection, just to get the service, just to get your phone working, you have to pay a fixed fee. I'm not very sure about the fee. Let's say 1,000 rupees. Okay, 1,000 rupees. You have to take any calls for the month. You still have to pay the fixed fee of 1,000, even if you don't take any calls. And then for every minute of your calls from there onwards, for every minute, starting from the first minute itself, you have to start paying a variable cost. This is one type of a semi-fixed cost. Semi-variable cost. Okay, so it starts at a fixed level, and then for every unit consumed from there onwards, you have to pay a variable cost. An example for this would be your telephone bill, right? So just for having the service, you have to pay a fixed cost, and for every unit consumed thereafter, you have to start paying a variable cost. So that is one type of semi-variable cost. Another name for semi-variable cost is mixed cost. Okay, another name for semi-variable cost is mixed cost, because it has characteristics of both variable cost as well as fixed cost. Okay, then the next one. This is the other type of semi-variable cost. Okay, there are two types of semi-variable costs. It could go like this. A certain period and then variable. Now in the first scenario, from the only you have to pay a fixed cost even if you produce 0 units, and then from the first unit onwards you have to start paying a variable cost. But here for a certain extent you have to pay a fixed cost. An example for this would be the 3-wheelers took service. Right now, let's say for example, for the first 500 meters you have to pay 50 rupees. Even if you don't go 500 meters, even if you go only 100 meters in the tuk or 200 meters, you still have to pay 50 rupees. It's fixed. And for every meter that you go after you exceed the limit of 500, you have to start paying more, a variable cost. That is something like this. To a certain extent, it's fixed. Let's say now this is 500 meters where I drew the line. This is 500 meters. Let's say you are traveling only 250 meters in this tuk. Still, you have to pay this 50 rupee fixed fee. Even if you are traveling this fee. But the moment you exceed the 500 meter limit, you have to start paying a variable fee. So an example for this would be the transportation by tuks. Okay, the meter taxi. So that is an example for this. So these are the two types of semi-variable costs that we have. All right, so I'll give you guys a few seconds to take down the graphs if you want. So keep in mind now the first assumption is total cost can be classified as either fixed cost or variable cost. But that assumption is not very practical, because in addition to fixed cost and variable cost, we also have stepped cost or semi-fixed cost and also semi-variable cost. Okay, so that assumption is not very practical. However, that's an assumption under CVP analysis. Okay, then so that's about it. Okay, so now write down the second assumption used in CVP analysis. Second assumption, so I'm going to erase the graphs. Second assumption is fixed cost does not vary with the activity level. Fixed cost does not vary with the activity level. Okay, so I hope you guys are taking this down as we move along. So fixed cost does not vary with the activity level. What does that mean? It means the assumption. It means what we said initially when we started. It's the cost that does not vary. So that's an assumption here as well. So that's true. That's true. That's what we call as fixed cost. However, in reality, right, in reality, sometimes, now when you're actually running a business, you would know that nothing stays fixed, nothing stays constant. It will change at least by a small percentage. Okay, so and also because of things like stepped costs, it does vary with the activity level, but not like variable cost, not by each and every unit that you produce, maybe by different quantities, different set of quantities. So fixed cost, you cannot say that it does not vary. I mean, ideally, when we study, we say fixed cost is the cost that doesn't vary. But in reality, in a practical scenario, nothing stays fixed. Everything varies at some point, at least in the long run or in the medium run. Okay, so that's the. Then the third assumption. Okay, so then the third assumption would be variable cost varies with the activity level. Okay, variable cost varies with the activity level. That is the third assumption that we make when it comes to CVP analysis. Now, okay, this is what we call as variable cost, right? The cost which varies with the activity level. But it could be different in certain scenarios. So let's say now, in some scenarios, our variable cost might change a little bit, right? It might change a little bit. Ideally, this is correct, but in a practical scenario, again, it might be a little bit different. It depends, right? So, but this is the third assumption we make. And the fourth assumption, so I'm just going to go through the assumptions soon. So, fourth one is costs and income behave as linear functions. Okay, within brackets, you can take down linear functions means they behave as straight lines. They are always straight lines, cost and income. They always behave as straight lines. Okay. That means if you draw, let's say if you try to show the revenue, we show it like this, like a straight line. But in reality, does it move like a straight line? In reality, does it move like a straight line? No, it doesn't. We have different other factors which influence the income, right? It could be something like the COVID-19 outbreak. It affects the income. So it actually doesn't move as a straight line in reality. It moves with fluctuations. It moves like this, right? So, but here we assume that cost and income, they behave as linear functions or as straight lines. That's another assumption we make. Okay. Then the next one is volume relevant to the activity level. Volume relevant to the activity level is the only factor which affects to the income and cost, which affects the income and cost. Okay, so what it says is that volume is the only factor which affects the income and the cost. But in reality, in a practical scenario again, volume is not the only factor which affects income and cost. There are other things like what else affect the income from the cost. Then inflation in the country, living standard, the economic downturn, or economic growth, things like that. Different things affect the income and cost. But here we assume volume or the activity level or the production level is the only thing which affects our income and costs. That's another assumption that we make. Okay, then the last assumption is technology, production methods and efficiency are fixed. Okay, so we assume technology, production methods, and efficiency, they are kept fixed. But again, in reality, does technology stay fixed? Does production methods, do they stay fixed? Efficiency, is it fixed? No, they change in reality. But here we assume for the convenience of the model that these things remain fixed. Okay, so these are the assumptions that we make when it comes to CVP analysis. So please take all of these assumptions down. First assumption is actually total cost can be classified as fixed and variable, and then these things. Okay, so altogether you have 6. Okay, so I hope you guys are done taking it down. So moving on to the next part. Okay, so next part is about, now we are moving into the important areas, which are the concepts when it comes to CVP analysis. Now everybody listen carefully, because this is what you will need when you're writing answers for the second paper. Okay, so you will get a CVP analysis question for the second paper, and this is usually a question that you shouldn't skip because it's comparatively an easy question, but it becomes easy if you get the hang of it from the start. If you get it wrong, then all your answers will be wrong. Okay, so listen carefully. This is a question where you can score marks. So try your best to give this question a try at the exam. Now, important concepts for CVP analysis. Okay, so first one is contribution. Does anyone know how we can calculate contribution? I'll give you guys a few seconds. Does anyone know the answer for calculating contribution? Yes, very good. So most of you guys know. Good. So contribution is the difference between the selling price per unit and variable cost per unit. Or else, if you want to find contribution per unit, how do you find it? That is selling price per unit minus variable cost per unit. If you want to get the total contribution, how do you get it? Total sales minus total variable cost. Okay, so that is going to be your contribution. All right, so just write down under contribution. Contribution per unit equals. Contribution per unit equals selling price per unit. Selling price per unit minus variable cost per unit. Minus variable cost per unit. Okay, that is contribution per unit. Now, under that, write down how do you calculate then total contribution. So, total contribution equals total sales minus total variable cost. Total contribution equals total sales minus total variable cost. Okay, and it's important to remember that total sales means what? Total sales means, just like put an arrow down and write, total sales means selling price per unit into the number of units. That's how you get this total sales, right? Selling price per unit multiplied by the number of units. The number of units. Then total variable cost also, how do you get it? Selling price, variable cost per unit multiplied by the number of units. Variable cost per unit multiplied by the number of units. Okay, so that's how you get it. Another way to calculate your total contribution is you can either go with this method, total sales minus total variable cost, or another way would be write down total contribution equals another way. Total contribution equals contribution per unit multiplied by the number of units. So these are just basic things, okay? Number of units. Okay, so that's another way. So you need to write down altogether 3 equations. First one is contribution per unit. How do you get it? Selling price per unit minus variable cost per unit. Second one is you need to get the total contribution. The first way of getting total contribution is total sales minus total variable cost. How do you get total sales? Selling price per unit multiplied by number of units. How do you get total variable cost? Variable cost per unit multiplied by number of units. Or else you can follow another method to calculate total contribution. That is, you get the contribution per unit from the first equation and then multiplied by the number of units that you have. Okay, so that is about that. So contribution, it's the most basic concept when it comes to CVP analysis. Next one is the contribution to sales ratio. So it's a ratio. Okay, so it sees contribution as a percentage of the sales that you have. Okay, so I'll be erasing this part. Now moving on to the next part, it's the contribution to sales ratio. Okay, so there you can write down. Actually, before we go into that, I'll just give a small example. Okay, small example on how to do that. So on contribution. So let's say selling price of a product is 50 rupees. Selling price is, you guys can take this down, is 50 rupees, right? And then variable cost per unit is, let's say 30 rupees. Okay, and then let's say the sales units 100 units. All right, so if you are required to calculate the contribution per unit, that would be, contribution per unit would be 50 minus 30, 20 rupees. If you are required to calculate the total contribution would be 2000. Good. 2000. That is 20 is the contribution per unit multiplied by the sales units that you have, 2000. So it's a small example on how to do that. Okay, you guys can take this down as well. Okay, next one is CS ratio, or contribution to sales ratio. Here we show contribution as a percentage. So take down the contribution to sales ratio equals contribution per unit divided by selling price per unit. It's a fraction, okay? And multiplied by 100. So it's a fraction, you need to put the line in the middle. Okay. So this is the CS ratio. Yes, good. Okay, so all of you guys know how to calculate this. This is one way. You either take contribution per unit divided by selling price per unit. Or else another way you can calculate this is you take the total contribution divided by total sales. Multiply by 100. Keep in mind, if you are taking per unit, both the numerator and denominator should be per unit amounts. If you are taking the totals, both numerator and denominator should be totals. Again, you multiply it by 100. So take down these two. So these are the two ways of calculating the CS ratio. You can follow either one of these two. Okay, you can follow either one of these two. Now, a small example. Okay, so I'm quickly erasing after I type it on the screen because I have to give you guys the example also. So another example for this, to calculate the CS ratio, let's say the selling price per unit is 400 rupees. And let's say the variable cost per unit is 200 rupees. Okay, so what is the CS ratio here? What is the contribution here? Contribution would be, I'll put the contribution. You guys tell me what the CS ratio is. Okay, yeah. Contribution is 200. What is the CS ratio? Yes, very good. CS ratio is 50%. Okay, yes, great. 50%. So how do you take it? Contribution per unit divided by selling price per unit. So contribution per unit is 200 divided by selling price per unit 400 multiplied by 100. That will give you 50%. Okay, so that's about CS ratio. Okay, so after every question, I'll give you guys a few seconds just to take it down. All right, moving on to an important part, that is the break-even point. Okay, break-even point. Okay, so break-even point is a point at which that we don't make any profits, no any losses. Okay, no profits, no losses at break-even. At break-even, total revenue is equal to your total cost. No profits, zero losses. So when you are trying to sell, okay, you guys tell me, now when you're trying to sell, should you always try to sell below break-even, at break-even, or above break-even? When you're trying to sell, should you try to sell below break-even, at break-even, or above break-even? Above. Yes, good. Above break-even point. All of you should try to sell. Okay, good. Really good. Above break-even point. Okay, so that's above break-even point means now break-even is where it's the minimum boundary, where there are no profits, no losses, total revenue is equal to total cost. If you produce a little bit above it, that means you're making a small profit. If you produce a lot above it, that means you're making the difference is going to be your profit. Okay, so you should always try to produce above, but keep in mind break-even is the minimum amount that you can produce. Okay, it's the minimum. You cannot go beyond break-even because then it will incur in losses. Okay, so that's about that. Break-even point increase whether it's not good for the business. Okay, it depends. I mean, break-even point sometimes could increase if your fixed cost increase. If your costs increase, break-even point could increase. That you cannot stop the break-even point from increasing. It depends on your cost. But it's okay if it increases as long as you can sell more. If your costs are increasing, you need to also make sure that there is a proper demand coming, proper sale coming into your business. Then even if your break-even point increases, if your demand is up here, still you will get a profit. It's a break-even point could fluctuate because of the changes in cost. So you need to always make sure that you sell somewhere above it, above the break-even point. Okay, so how do you calculate this break-even point? Now we said that at break-even, no profits, no losses, total revenue is equal to total cost and all that. Okay, so how do you calculate this break-even point? So write down the equation, break-even point, write down in units. It's where a lot of people make a lot of mistakes. So in units, break-even point in units equal fixed cost divided by the contribution per unit. Contribution per unit. Okay, so I'm getting few questions. So it's better to have a lower break-even point, of course. If your break-even point is low, that means your costs are also low. If you have a low fixed cost, your break-even point will be low. So it's a good scenario if you have a low break-even point. But sometimes fixed cost, there could be unavoidable cost. Because of that, your fixed cost increase and your break-even point also increase. What you should always try to do is increase your sales volume. If your sales volume increase and if there's a proper gap between break-even point and your sales volume, then you're good to go. Then you are making profits. And yes, break-even point, it's practical. It's a practical thing you can calculate. You can calculate the fixed cost as of now. As at this point, you can calculate the fixed cost that you have. They might stay constant, or they might not stay constant in the long run. It depends. But as at this point, the fixed cost that you have, you can calculate. Contribution per unit, you can calculate. It's a practical method of seeing your profit. Okay, you can follow this method. Okay, then I'm getting questions regarding the profit. So just wait for a bit. We'll get into the net profit part, and then I'll give you the equation for net profit. Okay, so for now, just write this down. Break-even point in units equal fixed cost divided by the contribution per unit. Okay, and the next one, break-even point in rupees. Now, the units means in the number of quantity. Break-even point in rupees equal total fixed cost. Now, in the previous one also, it's total fixed cost. Okay, total fixed cost divided by the CS ratio, contribution to sales ratio. Okay, that is one way of calculating break-even point in rupees. Or else you can also calculate break-even point in rupees. Another method is you take BEP in units, you multiply it by the selling price per unit. Okay, so you can follow either one of these two methods to calculate the BEP in rupees. Okay, so this is how you calculate break-even point. And I want you guys to take down a small note. So I will give you the note here. Yeah, I'll write it down here. BEP or break-even point is the production, is the level at which total revenue is equal to total cost. Here there are no profits. No losses. No losses. Okay, so that's about the break-even point. All right. Now, I'll give you guys a small question along with it as well. So let's say, I'm going to erase this. Let's say the selling price per unit is 5,000 rupees. Variable cost per unit is, let's say, 2,000 rupees. Total fixed cost, 3 million. And sales quantity, let's say 1,000 units. Calculate the break-even point in units. Okay, calculate the break-even point in units and please see if you can get the answer. Yes, good. 1,000. 1,000 is the answer. So how do you get cost, which is 3 million? Total fixed cost divided by the contribution per unit. How do you get the contribution per unit? Selling price per unit minus variable cost per unit. That is 3,000. Okay, so that will give you an answer of 1,000 equals 1,000. Okay, equals 1,000. Then calculate the break-even point in rupee value. What's the break-even point in rupee value? Yeah, break-even point in rupee value. So you can follow the equation of, what's the equation you can follow? Break-even point in units multiplied by the selling price per unit. So here break-even point in units is 1000. Selling price per unit is also 1000 equals 1 million. 1 million. That is the break-even point in rupee value. Sorry. Yes. I made a mistake here. Yeah, you're correct. So this should be actually, so sorry, 5,000. Selling price per unit is 5,000. So it's 5 million. You guys are correct. Okay. So yes. So this is how you can calculate. All right. So that means now since our sales level is also 1000, that means we are operating at break even. Our break even point is also 1000 and we are selling. Our selling level is also 1000. That means are we making any profits or losses? What do you guys think? Do we have any profits or losses? We don't have any profits or losses. No profits, no losses. Good. You know, no losses are either. Our sales units is 1000. Our break even is also 1000. I said break even point is a point at which no profits, no losses. Total revenue equals to total cost. So at this point, no profits, no losses. Okay. So that's about that. You guys can take down this question. So what we calculated was break even point in units and then break even point in rupee value. And then finally we said no profits, no losses because we are operating at break even level. Okay. Now going into, okay, so at break even point, next part, it's about at break even point, what actually happens. Okay. So at break even point, like I told you guys, total revenue is equal to, or total income, let's say, total income is equal to total cost. Right? That's what I said. And you know, an assumption in break-even is that total cost is classified as total fixed cost and total variable cost. Total cost contains of fixed cost and variable cost. So total income, so if we expand this a little bit, total income equals total fixed cost plus total variable cost. Because these two together is your total cost when it comes to CVP, according to the assumptions we made. Right? Then we said, since total contribution equals to what? We said total contribution is what? Total income or total sales, total income minus total variable cost. That's what we said. Okay. So now in this equation, you can move it around a little bit. Okay. You guys must have learned when you were doing O levels, you can move it around a little bit. Right? So when you move it around a little bit, move this, the three components around a little bit, you will get that total you will get that total contribution equals the total fixed cost. Total contribution equals the total fixed cost. Okay, that's what you will get when you move this around a little bit, keeping this in mind, since total contribution equals total income minus total variable cost. Okay, so I'll just show you how you can get that. Now, taking from here, taking this down, taking this part down. We have total income in one side. Let's take total variable cost to that side. You know, when it goes to the other side of the equation, it becomes minus, right? So it becomes minus total variable cost. Then equals total fixed cost. Now we know total income minus total variable cost means what? The total contribution. So therefore total contribution is equal to total fixed cost. Okay, so at break-even point, yes, only at break-even point. Only at break-even point, total contribution is equal to total fixed costs. This is what happens at the break-even point. It's very important to remember. Okay, so write down how it comes. So first thing is at break-even point, we initially said total income is equal to total cost. Then total income is equal to total cost means total cost is of two types as total fixed cost and total variable cost. So therefore, total income is equal to total fixed cost and total variable cost. If you take total variable cost to the other side of the equation, then in the left-hand side, you will have total income minus total variable cost equals total fixed cost. You know that total income minus total variable cost means what? That it means total contribution. So therefore, ultimately, we can say total contribution equals to total fixed cost at break-even point, only at break-even point. Okay, only at break-even point. So please take these steps down. Okay, these are very important. So now you need to know, okay, then at break-even point, no profits, no losses, total income is equal to total cost, as well as total contribution is equal to total fixed cost. Okay, so you need to know all of these things. So highlight the important equations. Important ones would be the first one, total income equals total cost, and the final one, total contribution equals total fixed cost. Okay. So that's about the break-even point, how it is at the break-even point. Okay. So I hope by now you guys are done taking it down. All right. Now moving on to the next part, that is the net profit computation. How do you get the net profit computation? Okay. Now, I'll take it to another screen. Profit equals what? Total income minus what? How do you get the profit in a normal scenario? Total income minus net profit equals total income minus we have total cost. Yes, good. Not fixed cost. Total income minus total cost. This is how we get profit, right? Normal scenario in a normal day-to-day basis. If somebody asks you to calculate the profit, how do you get the profit? The total income that you got minus the total cost that you had. Then you get the profit, right? Now, if we expand this a little bit, we can write down, okay, then net profit equals total income minus, we have variable cost, in brackets, total variable cost plus total fixed cost, because these two is what total cost comprise of according to the assumption. Okay, then we can expand this a little bit like this. All right, so up to here, I hope it's clear to everybody. Okay, how we came into the second equation using the first one. That's because of the assumption that total under CVP analysis, total cost comprise of the variable cost as well as the fixed cost. And then what happens is, now we know that total income minus total variable cost equals to what? This is equal to total contribution again. Total sales income minus total variable cost is equal to the total contribution. Okay, we know that already. Because of that, we can rewrite this equation, net plus total contribution minus what? What do you guys think? Minus what? It becomes minus because the plus mark gets multiplied by the minus mark over here. The bracket is there, so it's mathematical. It becomes, yes, very good. Total fixed cost. Okay, so keep in mind, using this equation we developed, the net profit equation. So net profit equals total contribution minus total fixed cost. Now we know at break even, total, okay. Wait, just listen carefully first and then take down. We know at break even point, total contribution is equal to total fixed cost, right? So let's assume total contribution is 100,000 and total fixed cost is also 100,000. Okay. So why do we say at break even we don't have any profit? So let's take the net profit equation now. It's total contribution minus total fixed cost, right? So both are 100,000. 100,000 minus 100,000 is 0. So that means at break even, profit is 0. But the moment total contribution exceeds total fixed cost, if we have more total contribution than total fixed cost, let's say now total contribution is not 100,000, 200,000. Now we will be making a profit of 100,000. Okay, so at break-even point, total contribution is equal to total fixed cost at break-even point. But if you are calculating net profit, you get a profit when you produce not at break-even, if you produce more than the break-even point. Then how do you get the net profit? That is total contribution minus the total fixed cost. Okay, so I hope this is completely clear for all of you, how you get the net profit equation. Okay, so now you guys can take it down. First start from here, net profit equal total income minus total cost, and show how total cost is divided into these two, and put a curly bracket and show total income minus total variable cost. We call it total contribution. Therefore, the final net profit equation is this. Okay, I'll put a box around it. This is what you need to take down. And the one below it is just an example. You can take down if you need. Okay. All right. So that's about it. Okay. So next we'll go back to the tute and we'll see what's next. So next part, it's about margin of safety. It's about margin of safety. Margin of safety. Margin of safety means it's pretty easy to calculate. Margin of safety means, let's say we are selling our sales volume is we are selling, let's say 100,000 units. But our break-even point in units is, let's say, in units, let's say it's 80,000 units. Then our margin of break-even is the minimum amount. Then what do you guys think our safety number of units is? What is our safety net? So here, margin of safety in units equal, yes, very good. Margin of safety in units equal 100,000 minus 80,000. 20,000 units. That is our margin of safety in units. Okay, so let's say our selling price per unit is 10 rupees. Then our margin of safety in rupees will be how much? Margin of safety in rupees will be equals, when price is 10, then it will be 200,000 rupees. Okay, so that's how we calculate. Yes, good, 200,000. That's how we calculate margin of safety. It's pretty easy. Okay, you take the difference between break-even and the sales units. If you are required to calculate in rupee value, you can follow this method. You get the units multiplied by the rupee value, or else there's another way to calculate. I'll give you that equation as well. Okay, so first take down under margin of safety. This is the difference between budgeted or actual sales volume, and break-even sales volume. Okay, and break-even sales volume. So write down margin of safety in units equal margin of safety in units equals budgeted or actual sales volume. This is the sales volume. They'll give you this at the exam. And the question will specify sales in units minus break-even point in units. Yeah, margin of safety, the definition I gave, it's the difference between budgeted or actual sales volume and break-even sales volume. Okay, and break-even sales volume. Then next one, margin of safety in rupee value. How do you calculate? Margin of safety in rupees equal margin of safety in units multiplied by selling price per unit, or else another method is, I'll just write in front equal, or else you can follow this method, net profit divided by the CS ratio, contribution to sales ratio. Okay, that's another method you can follow. And take down one more equation. So I'm just giving you all these equations. They might be useful at the exam, they might not. Okay, so I'm just giving all the equations I know. Margin of safety ratio equals margin of safety divided by the actual or budgeted sales. Okay, but it's important for you to remember all the equations because it depends on the question. You might have to use one of those, so you need to know all of them. Okay, so you can take down an example. The sales volume is, let's say, 5,000. Break-even point in units is 2,000. Margin of safety is going to be how much? It's going to be 3,000. The difference between the two, the actual or budgeted sales and the break-even point. In the ratio, you can use now, if you're using margin of safety in rupees, then actual or budgeted sales should also be in rupees. If you are using margin of safety in units, actual or budgeted sales also should be in units. Whatever you are using, both has to be numerator and denominator should be in the same method. Okay, same. It should be the same, either units or rupees. You can use either one of those two. Okay, so I think you guys had enough time to take this down. Now moving on to the next part of the lesson. Actually, there's another point called net profit. So there's a way to calculate net profit. Margin of safety ratio. Okay, so you have a concern about ratio. Margin of safety ratio, it shows margin of safety as a proportion of the total sales that you have. It shows margin of safety, how much of a safety margin do we have as a proportion of the sales that we are making. Okay, so it's just a ratio. Keep that in mind. There are also, if you use margin of safety in units, actual low budgeted sales should also be in units. If margin of safety is in rupees, then actual low budgeted sales should also be in rupees. Same function should be used by both. Okay, then I'll be erasing this part now. Okay, so there's another way to calculate net profit using the margin of safety. Okay, so just take this also down. It might be important for you sometimes, so just take it down. Margin of safety value multiplied by the CS ratio. That's another way to calculate the net profit, margin of safety value. Value means rupee. Always keep that in mind. Word value means rupee, or else they will say units. It's either value or units into CS ratio. And under that, also write down one more thing. Net profit per unit. How do you get the net profit per unit using margin of safety? That would be margin of safety units. Margin of safety units multiplied by contribution per unit. Okay, contribution per unit. Just take down these equations also, because they might be useful for you. Okay, now going into the next part, it says that CVP can be explained in two ways. We can explain CVP in two ways. Okay, we can either have the equation approach or we can have the graphical approach. So equation approach is what we have been doing up to now. Okay, you can follow the equation approach or graphical approach. So adding up to the equations that you know up to now. Okay, so I want you guys to take these also down there on the equation approach. So now, again, just to show how things comes, we said that net profit equals total income minus total cost, right? And then we said, okay, so in that case, net profit is equal to total income minus total variable cost, total fixed cost. Then we said, okay, then net profit is equal to total income and total variable cost. That part is total contribution. So therefore, total contribution, write it inwards, total contribution minus total fixed cost. Okay, so that's what we said. Now, if you take this equation down, now, since these are equations, mathematically, we can expand them and we can change it into different equations. Okay, so that is the equation approach. So you just have to keep the equations in mind. Okay, so it's not that difficult. So net profit equals, if you expand this equation, net profit is equal to, how do you get the selling total income? Total income is the selling price per unit multiplied by the quantity, right? Minus, how do you get the total variable cost? That is variable cost per unit multiplied by the quantity minus the total fixed cost, right? This is if you expand the second equation, which I put an arrow and show. And if you change these, finally, you can get an equation for the variable cost as well as the fixed cost. Okay, so I just want you guys to take these equations down for your reference. So variable cost is equal then to sales value, value means rupee value, into 1 minus CS ratio. 1 minus CS ratio. And then fixed costs are equal to sales value into CS ratio, close brackets, minus net profit. Okay, so these are some equations that you need to know. So just take these equations down and study these two equations. This is what's important. So highlight these two as well. And if you want to know how we got there, that is by using this equation just on top of it. Okay, so please take these things down. All right, then going back to the tute. So we are almost done with the equations. So going back to the tute. Okay, so now we are going to calculate the required sales value to earn an expected profit. That means in order to get a profit, okay, we tell at the beginning we need to get a profit of 100,000 this year. So in order to get a profit of 100,000, last equation, I'll read out the last see there, check. Yeah, it's there. Quickly take down the last equation. Okay. Then going back to the tute. So now we are going to see, okay, now before we start the year, we say, okay, we want to get a profit of 100,000. Okay, then we say, then we think, okay, so in order to get a profit of 100,000, how many units should we sell? That's what we are going to calculate. We are going to calculate the required sales value in order to get an expected profit. Okay, in order to get an expected profit. So first you guys can take down, now the equation for this would be the sales value that we need, sales that we require, the required sales in units, the number of units that we are required to sell, equals fixed cost plus our target profit. Now in that example, the target profit is 100,000. In order to get 100,000, how many units should we sell? So fixed cost plus the target profit in the numerator divided by contribution per unit. Okay, so by using this equation, you can identify, okay, in order to get a profit of this much, profit of 100,000 or whatever the profit you want, how many units should we sell? How many units should we sell in order to get this much of a target profit? That's what we can calculate using this. Okay, so, and one more thing, it's important to remember, sometimes in questions, they'll give you the target profit and they'll ask you to find the sales in units. So this will be the unknown thing that you need to find. Then no problem, right? You can just put this fraction. But sometimes they might tell you the sales units and they will ask you to find the target profit. They will ask you to find the profit. Then you can still use the same equation like this. Instead, you just have to put the X value to target profit. And I hope you guys know how to simplify. Then you will know the sales in units, you will know the fixed cost, you will know the contribution per unit. So you have to take contribution per unit to the other side, then fixed cost to the other side, then you will get, okay, target profit equals what? Okay, so using this equation, they could ask both the sales units, if others are given, or target profit if everything else is given. Both could be questions, so you can use the same equation. Okay, then, so that is to calculate sales, required sales in units. So we'll see how to calculate required sales in rupee terms. Sales in rupees equals fixed cost plus target profit divided by the CS ratio. Okay, divided by the CS ratio. or else another way is an easy way. You get the sales in units from top, required sales in units, you get it from top using the first equation. You multiply it by the selling price per unit. Okay, you can follow that method as well. Okay, so this is to calculate the required value when they say, okay, this is our expected profit. In order to get this much of a profit, how many units should we sell? Okay, so that for that you can use this equation. Or else if they say we are selling this many units, how much of a profit will we get? Okay, it could be either way. They say this is the profit that we want, how many units should we sell? Or else they will say, okay, this is the number of units we can sell, what is the profit we will get? For both of those questions, you can use these equations. Okay, sales in units and sales in rupee value. Okay, so up to now, I hope it's clear for all of you. Okay, so if you guys have any doubts, feel free to ask. If not, we'll move ahead. Okay, now we are going into the graphical approach. Now we are done with the equation approach. Now we are moving into the graphical approach. So there I want you guys to take down these graphs. Okay, I want you all to take down the graph if you do not have the graph. If you have the graph, then that's fine. If you do not have it, please take them down. Okay, so on the graphical approach, the first one that we have is what we call the traditional break-even chart. Okay, so traditional break-even chart, we construct this using total revenue, total cost, and total fixed cost curves. Okay, so let me get the file ready for you guys. Just give me 1 second. Okay, so this is going to be this is the traditional break-even chart. Okay, this is how the traditional break-even chart looks like. So keep in mind, in the traditional break-even chart, we have the total revenue curve, which is the sales curve, the total cost curve, and the fixed cost curve. So write it down. In the traditional break-even chart, we have the total revenue curve, total cost curve, and the total fixed cost. You see, we have 3 curves. One goes like this, one like this. Okay, so you guys can take this down. Okay, take down this chart. So while you take down, I'll explain it to you what this chart is. So this axis, it represents the cost or the revenue, the rupee value. And this axis, the horizontal one, it represents the units, the number of units that you have. Okay, so let's take it up a bit. Okay, all right. Now you see that total fixed cost, it starts at this point, right? It starts at a particular point, total fixed cost. Let's say it starts at 10,000 rupees. This is 10,000 rupees. And now do you see this total cost curve? Total cost also starts from there. Total cost doesn't start from 0. The reason is total cost comprise of both total fixed cost as well as total variable cost. Total cost or total variable cost. Okay. Actually, I'm not pretty sure how to make it smaller, so I hope it's done. Okay, now I think it's okay. Right? Okay. So now you see this is the total cost curve. Okay, so total. Now listen carefully. The reason why it starts from that point, the reason why it's not starting from 0, but starting from this point is because total cost at 0 level, still your total cost will be the total fixed cost. At 0 level, you'll still have to pay the total fixed cost amount. Then everything else that goes from here upward is going to be your variable cost. So the difference between your total cost curve and the total fixed cost curve is going to be your total variable cost. This part is going to be your variable cost. Okay, so I hope it's clear. And the total revenue, it starts from 0. So if you are selling 0 units, your income is 0, right? If you're selling 0, your income is 0. The moment that you start selling only, your income will go up. So that's your total sales. It starts from 0. And then, so you see the point where the total cost and the total revenue curve intersect. This point. The point where total cost is equal to total revenue. That's what we call the break-even point. The point where total sales is equal to total cost. That is the break-even point. So break-even point, if you extend this line here, this is the break-even point in units because this is the quantity axis. And this is the break-even point in rupee value. Okay, break-even point in rupee value. And if you produce anywhere here, anywhere in this range, will you be making a profit or a loss? What do you guys think? Now, total cost curve goes like this. Total revenue goes like this. Yes, good. We'll be making losses if you produce here. If you produce anything more than the break-even point, you'll be making profits. Anything more than the break-even point, you'll be making profits. Okay. So now you see that this is the break-even point means if you produce at this point, if we're actually selling at this point, the difference from break-even point in units to selling point in units, that is our margin of safety in units. The difference between the two, margin of safety in units. So here, this is now, if you extend this up, this is the selling units, the point where you touch your sales curve, you get the sales value. This is the sales value that you're actually receiving, sales value, rupees value. So the difference between the sales value and the break-even value is what we call margin of safety in rupees. Okay, margin of safety in rupees. Okay, so that's about the traditional break-even chart. So right now, this has 3 curves, that is the total revenue curve, total cost curve, and the fixed cost curve. Total revenue, total fixed, and total revenue, total cost, and total fixed cost curve. Okay, so I'll give you guys a few seconds to take it down, and or else you can take a screenshot or something. Okay. Okay, so I'll move on to the next graph. Next one is the contribution break-even chart. Okay, so these graphs are important. Sometimes they are questioned in the first paper. So next one is contribution break-even graph or break-even chart. Take down the topic, contribution break-even chart. Okay, so here we have the lines. We have the total cost, total sales, and the variable cost. Now we don't have fixed cost curve. Instead of the fixed cost curve, we have the variable cost curve. Okay, we have the total cost curve, total sales, and the variable cost curve. So this is the contribution break-even point graph. Again, so you see here, first I'll explain. Okay, so you see that sales start from 0. So like I explained, the same justification. And if you are not selling anything, your sales value will always be 0. The moment that you start selling only, your income will go up. So that's why it starts from 0. However, the total cost curve starts from this point because even if you produce 0 units, still you have to incur a fixed cost. So the fixed cost value is the value at this point. Total variable cost, it also starts from 0 because total variable cost increase the moment you start producing. The moment you start selling or producing, only the variable cost will increase. However, the fixed cost is there even if you are producing or selling at the 0 level. Okay, so the fixed cost is the difference between now the total cost and the variable cost curve. Previously, it was the total variable cost was the difference between total cost and fixed cost curves. Okay, and everything else is the same. Break-even point is where the sales and the total cost lines meet. Break-even point in units, sales value, and the margin of safety. Everything else is the same. Okay, I'll give you guys a few seconds. Yes. Variable cost is parallel to total cost. It's parallel to total cost. I'll give you guys a few seconds to take down. And if anybody has any questions regarding this, please drop a text and ask. I don't think this is very confusing. When you're studying, you need to study, okay, what are these lines? You need to be able to name the lines. And again, like before, this part is the loss-making area. When you produce below the break-even point, this part is the profit-making area. Okay, then moving on to the final graph or final chart, that is the profit volume chart. Okay, moving on to the final one, the profit volume chart. Okay, so take down the topic, profit volume chart. Okay, so this is the profit volume chart. So it only it doesn't now here. It's not like the previous two. In the previous two, we only showed the cost lines, right? We only showed the cost. Okay, last one. Please take a screenshot so you can take it down. Okay. Then moving on to the next one, that is the profit volume chart. Write down the topic, profit volume chart. Okay, these charts you can draw on your own if you take a photo or something, because it's not that difficult. Just listen to the explanation. Okay, just listen to the explanation. So profit volume chart, it doesn't show any cost lines like it did before. It doesn't show the cost. It doesn't show total cost, total revenue, all those things. This only shows how profit and the losses change when the volume change. It only talks about profits and the losses. Now, previous ones talked about profit and losses, but indirectly. They mainly talked about the cost lines and the revenue line. But here we are directly talking about the profits and the losses. So here you see, now this is the quantity, sales units, and this line shows the profits and the losses. So negative side means losses, positive side means profits. So initially you will be making losses up until the break-even point. Then at break-even point, you will be making zero profits, zero losses. And the moment you start producing more than the break-even point, your profit will start going up. Okay, so that shows. All right. So that shows the relationship between profit and volume when the activity level changes. Okay, so I hope it's clear for all of you. So if you have any questions, again, feel free to ask. So this shows actually how profit and volume changes when the activity level changes. Okay, so take down this graph as well. Okay. Then, so we'll move back to the tute and we are coming into the last parts of it. Okay, so okay, so next part, it's about we did the charts, we do the graphs. Then we are talking about the limitations of CVP analysis. Okay, so this is something that you guys can write on your own. Now, when we discuss CVP analysis, we classified all costs as total variable cost and total fixed cost. Is it practical? No, it's not. So that's the first limitation. It's not practical to classify the total cost as just as total fixed and total variable. It's not very practical because we have semi-fixed, semi-variable cost as well. Okay, so first limitation is it's not practical to classify all costs as total fixed and total variable cost. Okay, so write that down. It's not practical to classify all costs as total fixed cost and total variable cost. Okay, and the second one is when the volume increase, the fixed cost also might increase. It might not stay constant throughout the years and years. Sometimes it might change in the medium run or in the long run. Fixed cost also might change. Okay, so second one is when the volume increase, sometimes the fixed cost also may increase. When the volume increase, sometimes the fixed cost may also increase. So example is step cost. Because of step cost, when the volume increase, step cost also increase, step fixed cost also increase. Next one, when the volume change, the variable cost and the selling price per unit may also change. When the volume change, the variable cost and the selling price per unit may also change. Okay, they may also change. So sometimes they may also change. Selling price, we don't keep it constant throughout the period, right? Sometimes we might increase the price, decrease the price based on the demand. Variable cost per unit also, sometimes it might be different based on the raw material prices and all those things. So those are the limitations. Because of those limitations, this model is not 100% practical, but it does help us to a certain extent. Okay, so with that, we are down to the last part of the lesson, that is sensitivity analysis. Okay, so sensitivity analysis. So what this measures, sensitivity analysis, what it measures is it analyzes the changes in different variables which affect the net profit. For example, we check, okay, if selling price increase, selling price is 10 rupees. If it goes up to 20 rupees, how will our net profit change? How will our margin of safety change? How will our break-even point change? Likewise, we analyze. So that is about selling price. And then we say, okay, if sales volume, the number of units, if it changed from 100,000 to 200,000, how will our break-even change? How will our margin of safety change? How will our net profit change? That's what we are trying to analyze here under sensitivity analysis. We are trying to see how sensitive this net profit and all these are to changes in selling price and sales volume. We are mainly taking the changes in selling price and sales volume. Okay, so write down under sensitivity analysis. So I'll type it here as well. Analysis of the changes in different variables which affect the net profit is known as sensitivity analysis. Okay, so these variables are, so these are the ones that we change. These variables are selling price and sales volume. Okay, and then write down a separate point. When one variable changes, we assume all other variables are kept constant. Okay, so that means when we change the selling price, we assume everything else is constant. When we change the sales volume, we assume everything else is constant. We only assume only that variable changes. Okay, so that's about sensitivity analysis. So we'll discuss sensitivity analysis with a question and then we'll finish it off. Okay, so now there is a question that I want you guys to try. Okay. I hope you're done taking this down. So I'll be raising it. Now look at this question. Okay, so here, now cost estimates of product XYZ are as follows. Selling price per unit, raw material cost per unit, direct labor cost per unit, other direct cost per unit, monthly fixed cost, monthly sales. Okay, now out of here, it's important to remember that variable cost means all the direct cost. Variable cost means the cost which varies with the output, with the every unit. Okay, so then that includes all the direct costs, that is direct material, direct labor, direct other, that is variable production cost, and also if there are any variable non-production cost, that is also variable. So here, you know, this raw material cost per unit, direct labor cost per unit, if anything is given per unit, those are variable costs. Okay, so direct labor cost per unit, other direct costs per unit, those are variable costs. So your variable cost altogether will be how much? 15 rupees. 8 plus 5 plus 2. These three together will be 15 rupees. Okay, so I'll give you guys to quickly take down the question. So I just want you to take down this part. Okay, only this part. So your variable cost is going to be what? The per unit cost, raw material cost per unit, direct labor cost per unit, and other direct cost per unit. Okay, so calculate the contribution per unit then. Selling price per unit is given, variable cost we just calculated. What is contribution per unit? What do you guys think? Yes, contribution per unit is going to be exactly 20 rupees. 20 rupees is your contribution per unit. All right, next, calculate the break-even point in units. Calculate the break-even point in units. How do you get it? Fixed cost divided by contribution per unit. So what is the break-even point in units? Yes, good. 12,000. 12,000 units. So I think I can see that a lot of people understood. So 12,000 units. Next one, calculate the margin of safety in units. Our break-even is 12,000. Our monthly sales, 32,000. What is our margin of safety? Exactly, 20,000 units. Good, very good, 20,000 units. Then calculate the net profit. How do you get the net profit? Total contribution minus total fixed cost. So what is the total contribution if we are selling 32,000 units? You get the contribution per unit. You multiply it by 32,000, you will get the total contribution minus the total fixed cost. That is how much? Yes, very good. 400,000 rupees. So total, now you know net profit, how do you calculate? The equation is given, total contribution minus total fixed cost. So total contribution is what? Contribution per unit, which is 20, multiplied by the number of units you are selling, 32,000. That will give you 640,000. 640,000 minus the total fixed cost of 240,000 will give you 400,000 of net profit. Yes, TFC, total fixed cost, is 240. Okay, it will give you 400,000. Good. Now comes the tricky part. Now we are seeing the sensitivity. Now selling price is no longer 35. It was 35, right? Yeah, now it's no longer 35. Now it's moving up to 45. Selling price is now 45. Now calculate the new contribution per unit. If selling price is 45, what is the new contribution per unit? Yes, new contribution per unit is going to be how much? Now it's going to be 30 rupees. Yes, good, 30 rupees. Okay, that is 45 minus your variable cost of 15. it will give you 30 rupees. Now calculate the new break-even point. The new break-even point in units. New break-even point will be what? Total fixed cost divided by the contribution per unit. New break-even point is going to be 8,000 units, right? Yes, 8,000 units. It's going to be 8,000. Then calculate the new margin of safety. 8,000 is the break-even. We are selling 32,000. Then the new margin of safety would be 24,000, right? 24,000. So with that, calculate the new net profit. New net profit. New net profit would be total contribution minus total fixed cost. Same way, now the total contribution is going to be what? Now it's going to be 30 into our sales volume of 32,000. It's going to be 30 into 32,000. That will give you 30 into 32,000 will give you 960,000. This minus the total fixed cost of 240, new net profit is going to be 720,000. Okay. Yes, good. 720,000. So now you see net profit has increased because of the increase in selling price. So if selling price increase, your net profit also increase. Okay. Again, am I too fast? Okay, I'll just go slow and I'll tell you the answers for this. So here for these, okay. So the first one, if the selling price increased to 45, new contribution per unit is going to be 30. It's going to be 30. Okay, because selling price is 45 minus variable cost 15, it equals 30. Okay, the new break-even point in units is going to be 8,000 units. Okay, so how do you get the break-even point in units? Total fixed cost divided by contribution per unit. That is 240,000 divided by 30. 240,000 divided by 30. That will give you 8,000 units. Okay, and then next one. Margin of safety in units. Okay, so you guys will get the question if that's what if that's what's taking a lot of time. You'll get the PDF. Just take down the answers. Next one, margin of safety in units. Okay, so we know our break even is now how much? 8,000. And we are actually producing, here it says monthly sales 32,000 units. So our break even is 8,000, monthly sales 32,000. The difference is the margin of safety. So the difference would be 24,000 units. 24,000 units. 24,000 units. Okay. And the next one is net profit. Okay, great. Next one is net profit. Net profit, how do you calculate? Just take down the answers. In net profit, how do you calculate? Total contribution minus total fixed cost. Total contribution minus total fixed cost. So total contribution is what? 30 is the contribution per unit. 30 multiplied by the sales units of 32,000. 30 into 32,000 is your total contribution. Minus the fixed cost of 240,000. Okay, 240,000. That will give you a new net profit of 720,000. 720,000. Okay, so can you guys tell me what's the effect to the net profit due to the increase in the selling price? Did it increase or did it decrease? If it increased, by how much did it increase? Or if it decreased, by how much did it decrease? Exactly. It increased by 320,000. It increased by 320,000. Yes. Okay, so you can write down effect to the net profit increased by 320,000. Okay, next one. Now, if the sales volume decreased from 32,000 to 25,000. Now it's no longer 32,000, it's 25,000. Calculate the following. Now you need to know the new margin of safety. Okay, so yeah, you need to know the new margin of safety. So just ignore about these changes that you made at this level, at the 5th point, the changes that you made. Now take the previous break-even point and all that, the initial ones. So what is the new margin of safety? Exactly, 13,000. New margin of safety is 13,000. That is, how do you get it? 25,000 minus, here our break-even was 12,000, right? So the difference will be 13,000 units. And calculate the new net profit. Forgetting about this, don't worry about this, take the previous ones. What's the new net profit? Yes, good. 260,000. New net profit is 260,000. How do you get the net profit? Total contribution minus total fixed cost. Total contribution is going to be, previously we had a contribution per unit of 20, multiplied by, now the sales volume is 25,000, minus the total fixed costs. You will get 260,000. Okay, so you see when the sales volume decrease, what happened to margin of safety and what happened to net profit? So what happened to margin of safety? Did it increase or decrease when the sales volume decreased? Margin of safety, what happened to it? Yes, good, it decreased. Then net profit, what happened to the net profit when the margin, the sales volume decreased? The net profit also decreased. Exactly. Okay, so that's what I wanted you guys to understand from the question. So there's another similar question. You guys can try it on your own. Okay, you can give it a try on your own. It's not difficult. It's the same question. So try it on your own. So just take down in this table then. So when selling price per unit increase, what happened when selling price per unit increased? Break-even number of units decreased. First one, break-even number of units decreased. Break-even number of units decreased. Second point, what happened to your margin of safety when you increase the selling price? Margin of safety increases. Margin of safety increases. Okay, and then what happened to your expected profit, the net profit? Net profit also increases. Net profit also increases. Okay, so similarly, when the sales volume comes down, what happened? What happened to your break-even point? When the volume comes down, nothing happens to your break-even point, right? Break-even point, no change. First one, break-even point, no change. This is when sales volume comes down. Break-even point, no change. Here under this, when selling price per unit increase, break-even decreases. Okay, when selling price per unit increase, break-even point decreases. I'm talking about the left-hand side of the table. Okay, break-even point decreases, margin of safety increases, expected profit increases. Okay, and coming down to when sales volume comes down. When we decrease the sales volume now, volume is the number of units that we sell. Break-even point, no change. No change happens to the break-even point. Okay, break-even point, no change. Then margin of safety decreases. Margin of safety decreases. Expected profit decreases. Expected profit decreases. Okay, PDF is, I think, shared. Somebody mentioned that it was shared. If not, it will be shared soon. For the time being, you can just look at the PDF on the screen. It will be shared on the group if it's not. Okay, great. Okay, so one final time I'll repeat the table. First, I'm talking about the left-hand side. When selling price per unit increase, break-even number of units decrease. Break-even number of units decrease. Margin of safety increase. MOS, margin of safety increase. Net profit increase. Net profit increase. Okay, then I'm going to talk about the right-hand side. When sales volume comes down. So when sales volume comes down, no change in the break-even point. Okay, no change in the break-even point. Next one, margin of safety decreases. Margin of safety decreases. Net profit decreases. Net profit decreases. Okay, so that's about sensitivity analysis. Okay, so with that, we can conclude the CVP analysis part. Okay, so you guys can try the next question on your own. It's something similar. And on your own, you can try, okay, now what we wrote was when selling price per unit increase. Then try, okay, when it decrease, then what happens? Then it's the opposite of what happens here. When sales volume increase, now here it comes down. If it goes up, what happens? The opposite of what we wrote down here. Right? Likewise, you can take those things down on your own. Okay, so with that, we will be concluding the CVP analysis part. So now you guys can go ahead and try the past paper questions. It might be a little bit difficult at first, but try from easy past papers and then go up to the most recent ones. So I think you guys won't have a big problem when it comes to CVP analysis here onwards. Okay, so it was great to have this seminar with you guys. You guys were very cooperative and very interactive. So all the best for the exam. And yeah, hope all of you will get to nail the paper. So thank you.
And that concludes the 5th session of the seminar series, English Medium. Thank you so much, Hasrake, for joining and doing a comprehensive session. And thank you to all our participants for joining with us today. Hope to see you in another wonderful session. Until that, have a great day and stay safe.